Ever found yourself wondering how put options work in stock trading? Well, today we are embarking on a journey to unravel the mystery of put options. At its core, a put option is a contract that gives you, the buyer, the right but not the obligation to sell a specific amount of a stock at a predetermined price, known as the strike price, within a specified time frame. Think of it as a kind of insurance policy for your stock investments. If the stock price falls, you can use your put option as a protective shield, selling the stock at the higher strike price. It's a bearish strategy, which means you're betting on the stock price to go down. And the best part? You're only paying for the premium, the cost of the option, to have this right to sell the stock. It's like paying for a ticket to a potentially profitable show. Now that we've covered the basics, let's dive a little deeper. Buying a put is not as complicated as it may seem. It boils down to three main parts. Let's delve into these three components, shall we? First off, we have the bear market. This is where you start making money. If the market price drops below the price you've entered on that day, you're in the green. Think of it like a treasure hunt, but instead of finding gold, you're seeking a dropping market price. Next up, we have the tricky part. If the market price ascends above your entry point, you'll start to see some of your money slip away. It's like reverse King Midas. Everything you touch turns to, well, not gold. Finally, we reach the third part, the strike price. If the market price soars above this price, you'll wave goodbye to all your premium on expiry. But if it's below, there's a catch. On expiry, you have to sell away the stock at the strike price. Picture this as a game of hot potato, but instead of a potato, it's a stock. And if you're left holding it, you're buying it from the market to deliver. Now, let's sprinkle in some extra spice, the concept of implied volatility. This is like the weather of the stock market. High volatility, stormy weather with high risks, but also high rewards. Low volatility, a calm day with less risk, but also less reward. To calculate returns, you can use your buying power for options or calculate returns based on buying stock. It's like choosing your weapon of choice in a duel. Both can lead to victory, but each has its own strategy. When should you buy a put? Well, the best time is when the market is at resistance or after a market turns bearish. It's akin to surfing. You want to catch the wave at the right time. Buying a put in a bull market is like surfing in calm waters. You're taking on more risk, and time decay might wash all your premiums away. So those are the three key parts of buying a put. Easy, right? Like any investment, put options come with their own set of risks and rewards. Now, it's important to understand that put options are fundamentally a bearish strategy. You're essentially betting against the market, and that can lead to substantial rewards if you've read the market correctly. But it's not without risks. Put options can also serve as a hedging tool, providing a safety net in case the market takes a downturn. But remember, they are not a guaranteed protection against loss. Market trends can greatly impact your put options. For instance, if you've bought a put option and the market price rises above your strike price, you could lose your entire premium by the time of expiry. On the flip side, if the market price falls below the strike price, you'll be in the money, and that's where the rewards come in. But it's a delicate balance, and understanding the market and the risk involved is key to successful put options trading. Let's take a look at an example to better understand how put options work. Imagine you're a savvy trader who spots a bear market on the horizon for a stock that's currently trading at $50. You decide to buy a put option with a strike price of $45, paying a premium of $5 per share for the right to sell the stock. If the market price dips below the strike price, voila, you've hit the jackpot. But if it stays above the strike price, you're out of the premium cost. It's a high-stakes game, but with the right knowledge, the rewards can be substantial. For more in-depth learning and to enhance your trading strategies, I'd highly recommend bullbearvector.com. Their premium features, including the options ranking tool, can be a game changer, helping you save time and avoid costly missteps. And that's a wrap on put options. Remember, knowledge is power. The more you understand, the better your trading decisions will be.